All right, so everybody, thank you so much for being here. My name is David Wilmot. I'm a financial advisor at Point 32 Investment Partners under the umbrella of LPL. And I'm really excited to be giving this presentation with you all today. And the goal is to really talk about some high-level concepts that we do here at Point 32 in regards to retirement planning. So just as an agenda, what we're going to go over today is we're going to start with just where to start. If this is the first time you're thinking about this, or maybe this is timely to get going again, we're going to review income and expenses, what to focus on there. We're going to touch on Social Security. We're going to get to how much money you're going to need in retirement. And then if you're ready, the steps you can start taking. So without further ado, let's get started here. So some basic questions to start with. When you retire, what's your living situation going to do? Be like what will you do when you're in your retirement, when you have a bunch of free time? How much money do you think you're going to need? How much money do you have right now? And maybe what are some health related issues that might happen over the course of retirement? So having read these questions myself, these are ones I start with any client that comes to me. I'm sure you have some questions that are specific to you. What I would do right now is just take a moment and write those down so you have them. But we're really going to touch on these beginning parts of this. But the very first thing to do is to ask yourself these questions. What does retirement even look like for me? So the first thing I recommend with everybody, either whether they're in retirement or preparing for retirement, is start with figuring out what your budget. Okay, and what does a budget do? It's really a spending plan where it identifies where your money's going. And this isn't for me. I tell my clients all the time to say, I'm not here to be a stickler to say you're spending X on what or Y on that. It's really just a understanding for you to know where all your money is going. That being said, it can limit amounts spent on categories of expenses. So, when I meet with people, one of the big topics I say is, hey, look, you're going to need to save more to get to your retirement goal. And so you might need to change your spending. And when you know what your budget is, it'll be easy for you to make those necessary changes to ultimately help you reach your financial goal. So a budget ultimately it gives you control of your finances, knowing what's coming in and what's coming out. It keeps you organized. It helps you identify opportunities and let you know where you spend or stand financially, which I think is incredibly important. And it's being able to take advantage of opportunities. When your spending plan is operated, all your financial transactions will automatically be organized at income tax time. So it will, when it comes to filing taxes this time of year, knowing what your budget is will go a long way. And ideally, if we do our jobs right, this might actually hopefully lead to some chances to get some more money. So when it comes to expenses, when you're thinking about what your expenses are or what's going out, there's two types of costs. There's fixed costs and there's variable costs. And when I sit down with somebody and I say, hey, what are your expenses? Everybody knows what their fixed costs are. They can rattle this off. Oh, my mortgage is this, or I'm paying this much for my phone bill. My insurance is this. Everybody has a really good understanding of their fixed costs month to month. They're usually automated on the set day. You know what's going out. It's the variable expenses that ultimately not become a problem, but people don't really know what they're spending on. They maybe know what they're spending on food. They have an idea on gas, medical care. Things they don't think about are the vacation, the gifts, the personal purchases on Amazon that randomly show up the next day. You don't even remember what you bought. So it's the variable expenses that I have to work with people, and I recommend you do as well, to understand your variable costs, to help you understand your total costs in your expenses over the month-to-month period. And then once you know what your expenses are, the next step is to understand your income. So these are different types of income that I have here. The obvious one is your income from your job if you're a W-2 employee. But maybe you have some income from self-employment or a side job. Maybe if you're already in retirement, you have a pension or IRA distributions. There could be interest and dividends. While most of my clients are in the growth stage of their saving for retirement, there are some clients that are actually taking income. So having a dividend income is important. And then finally, there's Social Security. So once you know your income, and then once you know your expenses, what you have left, ideally is a pool of money that you can save for the future, depending on what your goals are. So in the first meeting and the second meeting I get with new prospective clients, understanding your income and understanding your expenses are incredibly important, because at the end, if we do our jobs right, we know how much money is left over at the end of the month that then we can start saving to and investing to for their personal needs. Okay, so the next step of this is, once you have your income and expenses, the next is to get a good understanding of what your assets and liabilities are. So when you start with a net worth calculation, keep in mind that you want to concentrate on the assets, not the income. Income flows into a cash flow statement, which we can also do with our clients, but the net worth statement, we really want to focus on assets. So some common ones include cash, stocks, bonds, and mutual funds, your financial assets. That could be in a 401k and an IRA or a brokerage account. Your home is usually your biggest asset. On the east end of Long Island, everyone home is by their primary asset on their financial statement. If you have any cars, trucks, boats, anything that I want you to think of an asset that you can liquidate. So furnishings that include antiques, jewelries, collectibles. These are all your assets. So going through and understanding the cost of all of this to get a good sense of what your assets are. And then once you have your assets, now you can think about your liabilities. So what you owe potentially on these assets or other debts. So when you think liabilities, I want you to think of the word debt. So your biggest one as well is your mortgage, but there might be others such as car or student loans. Credit card debt is a big one. Taxes due every year. While you don't, you pay those along the way, those are inevitably our liabilities. Major unpaid medical bills, and anything else that falls into the sphere of a debt owed to somebody else. It's also really important with these liabilities that you understand your payment schedule as well as the interest that you're paying on it when we look at cash flow. But when you add these two up, or you take the assets and you subtract the liabilities, that's how much your net worth is going to be at. You'll probably be pleasantly surprised and maybe be relieved for some people when you realize, oh, this is how much my net worth is at the end of the day. And again, the biggest piece of this puzzle is your home minus your mortgage. So when you calculate your net worth, it's important to know this if you're ever applying for a new loan. If you're preparing a will or a financial estate plan to know where all your assets are at, your net worth, this will help me as an advisor depend on your insurance needs. And then most importantly, knowing your net worth and then knowing your cash flow from income minus expenses can help myself and the team at Point 32 put together a plan of attack to progress toward your financial goals. So if we do an analysis and we say, hey, we need your retirement accounts to be at $1.5 million by the time you get to retirement in order to come up to supply your income needs. And we know off of your net worth statement that you have $480,000 in your IRA. Now we can develop a savings plan with your income and expenses to make sure we're funding this appropriately and investing it appropriately to get to what you're ultimately looking to do with your financial goals. So the next step of this is I want to touch on Social Security, and I'm going to preface this by saying Social Security is not a black box. That's not the right word, but it is, we're going into uncharted waters with Social Security. Let me put it like that. The laws are ever changing around Social Security. 2034 is our Social Security D-Day, where Social Security runs out of money. So in the coming years, we're going to see changes to Social Security. I tell all my clients, I'm not here to speculate on what is going to happen to Social Security. I'm going to work with the rules as they are right now for you as I build out your financial plan. But that being said, it is apparent to myself that, and the team here, that we are going to expect to see changes in Social Security. So take all this with a grain of salt for what I'm about to explain here, and just know that we could see changes with this in the future. So as of right now, the earliest you can receive Social Security is 62 years old. The latest you can take it is at 70 years old. And then there's this number that's called your full retirement age. And as you can see here, depending on how old you are, full retirement age changes. And the later, the older, or the like, how should I say this? The later in time you get from, as you can see, from 1938 to 1960, full retirement age is pushing up and up. If I were to speculate and think in the future, what change they're going to make is they're going to increase full retirement age for myself at 31 years old. My full retirement age will probably be around 75. Just an example for that. But this is what you mean. The earliest you can take it is 62. The latest you can take it is 70. And then your full retirement age is what you get on that Social Security statement. And if you head to ssa.gov, you'll be able to see what your full retirement age benefit is going to be. If you start taking your benefits earlier at full retirement age, right? If you take it the earliest as possible, you're actually going to get a reduced amount. As you can see here, the total percentage reduction is based on what age you are. But for example, for everyone 1960 and later, if you take it at 62, you're going to get a 30% reduction from what your full retirement age is. Again, if you wait longer than 67, your full retirement age, if you wait till 70, now you can see an increase in your full retirement or your monthly benefit of what you're going to get from Social Security. Which is really important for me as I am doing my analysis, and this team as Point 32, we're building out our financial plan for our clients. When you take Social Security is actually a crucial question that we have to answer. Do you take it as early as 62? Do you wait till 70? Do you take it at full retirement? And the answer is there is no right answer. It's based on your personal need. I have some people that take it as early as 62. I have some people that they delay it even after they're retired. It really depends on your cash flow, going back to those income and expenses to help you answer that question of when to take it. These are just some general principles to let you know to help you decide if you're planning on your own. The final piece to this is that, unfortunately, Social Security is subject to tax. So up to 85% of Social Security payouts are actually taxed back to the federal government. This is one of the ways, again, if we speculate on the future of what's going to happen to Social Security, these numbers might change in the future. But as of today, if you're an individual, if you receive more than $34,000 a year in Social Security, 85% of that is going to be taxed. And this is a number that we are going to have to factor in when we're coming up with your total income that you're going to get when you retire. This earnings annual limit is from 23. Again, a little outdated. In 25, this number is going to change as the tax code changes. But this is the amount of Social Security that you can receive while working. So I hear this a lot where, I want to get my money as soon as possible, David. Even though I'm going to work till 70, I want to take it at 62 years old. And I say that's great. But just so you're aware that if you're at age 62 and you're receiving benefits, has a full retirement age of 66, and earns $21,720 a year, just so you know, you get double tax. So for $1, you get back, every $2 on your earnings went over this limit, you're going to be paying double tax on that. So again, another piece of the puzzle to planning when to take Social Security has a lot to do with your income and your income needs, and if you're working or not. Again, if you head to ssa.gov, you will get a better understanding of your personal Social Security information. And this is the final piece. This is a value add I offer to all my clients at Point 32. When you get to that point, and you need to go to the SSA Social Security Administration office, there's usually one in most major towns. On the East End, it's Riverhead and Patchogue. I'd be happy to come with you and assist in the filing process with this. These are just some things you're going to need to bring with you if you want to go on your own to apply for Social Security. So your Social Security card being the biggest, information on where you live, your tax returns, your proof of citizenship, and your checkbook or other papers, because we live in a world now where this can be direct deposited into you. So that being said, I want to now focus back to the planning portion of this, which is to figure out how much money you're going to need in retirement. This is a key question that I work with people with in those initial meetings, is trying to identify that number. So a general rule of thumb is that whatever your current income is right now, multiply it by 0.75 or 75%, and that's how much money you're going to need in retirement. The reason why 0.75 is that in most people's situations, 25% of their income is going to a housing, a mortgage cost that in theory will fall off once you get to retirement. So that's how we come up with that. You can change this number. I change this number with people all the time. It can go as high as 90%. It can go as low as 75%. It can go lower based on your specific situation. But the general rule of thumb is 0.75. And when we think about where income is coming from, of the various sources, Social Security is about 37%. It's the highest individual factor of income, which is why we spent a whole 5 minutes just talking about it and the different ins and outs of it. Because right now, 1/3 of your income is going to be coming from Social Security. Some others would include your earnings, so selling of financial assets, asset income, whether that be dividends or coupons from loans. Some people, pensions are becoming less and less, and I'm more seeing that, like, unless you're a teacher or work for the state, you don't have a pension, but that's about 10% or 18 total between government and private pensions. It's so important to realize or recognize that when we're building a financial plan, the dollars, that 0.75, your salary times 0.75%, that's in today's dollars. And we need to now project that out into the future with an assumption of inflation. So these are just some real life examples that I see. A lot of people in New York's plan is to move to South Florida when they retire. The average cost today is about 361,000. We can expect that to increase to $500,000 over the next 10 years. Cruises. I see a lot of people want to take vacations in their retirement plan at least once a year. As you can see, over the next 10 years, we're expecting a 25% increase in these costs. So when we come up with that number of how much money you're going to need in retirement, the next stage of this is to build an inflation to it to find out what the actual dollar amount is going to be when you hit your retirement age. And then the next piece is to now factor in life expectancy. So for the average 65-year-old male, they can expect to live to 83. The average 65-year-old female can expect to live to 86. And I hear all the time, Dave, the national average for life expectancy is 75 years old. What are you talking about? Why are you planning for me to live till 90? And the reality is that that number is lowest for two reasons. It's overdoses and suicides. And so if you make it to 65 years old, the odds of you overdosing or committing suicide fall off a cliff. So if you're not in one of those two boxes, more and more people are living longer than ever. So when I build a financial plan for my clients, we assume at point 32 that you're going to live till 90 years old. And we have to factor in how much money you're going to need with rising costs. So if you retire at 65, we have to come up with 25 years of income that's also increasing in costs over that time period as well. Another big piece of the puzzle that we're looking at when we build financial plans is medical expenses. As the baby boomer generation goes into retirement, and we just hit the big one, this was the most baby boomers retiring ever was this year. We're also going to need to plan for medical expenses. And we can also expect for medical expenses to increase. And we'll touch on long-term care in a minute. But another core factor is that on top of medical costs for a plan, outside of your regular expenses, long-term care is becoming more and more of a factor. So the biggest piece of this is that Medicare, the eligibility age is 65 years old, and there's 4 parts that we're going to touch on right now. A good hack for this is most people say, I have to wait until I'm 65 to retire to get Medicare. And because of COBRA, which is a government program that allows you to stay on your health insurance for 18 months when you leave your job, the real retirement age could be 63 and a half. You hop on COBRA for 18 months, COBRA runs off, and then you hop on Medicare. So if you're worried about working till 65 to get to Medicare, you can actually get away with it at 63 and a half because of COBRA. So here are the 4 parts. There's Part A, which is hospital insurance. This is what you all are paying into every month when you get taxed. Your taxable income has Part A built into it. Part B is medical insurance. So not going for an emergency situation in a hospital, but actually seeing doctors. There's Part C, which is Medicare Advantage plan. I want you to think of HMOs and PPOs that provide hospital and medical insurance under Part A and Part B. So this is a private insurance built on top of it. And then Part D is involved for prescription drugs. Okay. Part A is usually 0, again, because you're paying taxes into that your whole life. Part B ranges depending on the state and how much coverage you're looking for. And this is something that can be deducted out of your Social Security payment check as well. And Part C and D vary by plans based on your individual needs. You can, if all those options are not up to what you're looking for, you can actually get Medigap, which is a supplemental policy on top of it. These are some websites that you can go to learn more about Medigap supplemental insurance. And then there's long-term care. And I see this all the time as I talk to long-term care with my clients, which is who needs it? I don't need it. It's not for me. And people have to realize that as time goes on, the last 2 years of your life, more and more people are going to need long-term care insurance. So this is longtermcare.gov. This is a great resource to have. Long-term care insurance is something we talk about constantly at Point 32 since I've joined, something I brought into this practice. You need to expect that the last 2 years of your life, you're going to need long-term care. So are you ready? So by being a part of this meeting and joining, and thank you for my attendees, I'm going to send you guys in a wrap-up email or a follow-up email 3 separate documents that I'm going to give to you that you guys can work through to help assess that if you're ready or on your right track to retirement. So a quick breakdown of these. So a retirement timeline for people, if you're before the age of 50, your goal should be to save as much as you can. And that's something I can sit with you and come up with a saving strategy for. But starting at age 50, I see that light bulb come up for a lot of people and they say, oh man, I am closer to retirement than I am like for my working career. I need to start thinking about this. So some big ones are at age 50, you can actually do catch-up contributions into your retirement accounts. 59 and a half, you can start pulling from these without a penalty. 62, as we mentioned, is the earliest you can take Social Security. 65 is for Medicare. But remember, with an asterisk, you could probably take it at 63 and a half if you get COBRA through your job. 66 is the full Social Security benefits from 43 to 1954. 67 and a half is for the majority of my clients now. And at 73, RMDs kick in. So if you have 401ks, IRAs at 73 years old, the IRS is going to start making you take money out of these accounts. So here we go. Looking over these, right? So the first part of the worksheet A is just today's money. This is just a basic net worth sheet of your assets, right? Your retirement savings, your home equity, personal savings. Think of your assets for today's money. Your money in 10 years. So this is just a quick calculation to see where your investable assets are at, multiplied by your investable growth rate to see what your money could be like 10 years out from now. Part C, new savings between now and retirement. So this would include making recommendations to saving more, maybe opening up an IRA and maxing it out, maybe trying to push for that catch-up limit once you get over 50 to get a good sense of what your savings are between now and retirement. Your monthly income over a 30-year retirement. So again, take your current salary right now, multiply it by 0.75. That'll get you your projected income that you're going to need in retirement. Divided by 12 is your monthly. And then we could factor in inflation into that as well. Monthly expenses today, again, going back to your income and expenses, this is a good breakdown of your fixed and variable costs. A whole list of all of them. You could itemize them out. A good exercise is we're on the 5th of February. For the month of February, just spend freely. And at the end of the month, when you get your bank statements, go through and fill in the sheet. You'll have a good sense of what your spending is. Your monthly expenses in 10 years. So again, what are today's costs? Now let's inflate them out 10 years from now to see where you can get to. Again, very fixed and variable costs all factored into this. Comparing projected income and expenses, right? So as you can assume, up top, we have an assumed rate of return with inflation. So this will help you see what your income and what your costs are going to look like. You can actually inflate it yourself over the long run. Additional savings needed for retirement. So this will show you some different savings factors that you can look at to help you increase additional savings to help you get to those goals, as I mentioned before. And that's really it. So these are some useful resources that we talked about within the meeting to help you with some information. Again, we'll get you these all out to you in a recap email, but these are some useful tools if you want to look into this yourself. And guys, I believe that is it here. So that's going to be the end of this. This is my ask for if you guys have any questions of what we talked about, anything specific to your financial situation, or if you don't want to even go through these worksheets, if you want to meet with me and go through these worksheets together, that'd be something more than willing that I'm going to do with you guys for sitting through this and taking some information out of it. So feel free to shoot me an email at david@point32investmentpartners.com. At the end of the day, this presentation was created for educational and information purposes only, right? So this is not intended for specific investment advice, any tax or legal advice at the end of the day. If you are seeking investment advice specific to your needs, such advice services must be obtained on your own, separate from this educational presentation. This is my CYA to say, not financial advice, do your own research. But that being said, I want to thank you for attending this meeting. Myself, the whole team at Point 32 Investment Partners are really here to service people for what's most important to you financially. Here's our contact information outside of myself if you ever want to reach out. And again, I thank you for joining this, and I encourage you guys as an ask to build out a financial plan. Planning for the future is more important than ever with inflation and these questions around Social Security that I mentioned, pensions becoming a thing of the past. You having to put the work in to plan for retirement is so crucial, and we're here to help you build out a financial plan to make it happen at the end of the day. So on that note, I'm going to stop this share here and say thank you so much for attending, guys. I appreciate you all, and we'll talk soon. Have a good day.